Financial modeling, topic 21, capital budgeting, section 3. Evaluate a buy or lease decision and understand the importance of tax shields. So, a company's looking to get a computer. Now, the computer is going to have no incremental revenue impact. And the question is just, do you buy or lease it? Now, the computer purchase cost would be $4,000 today, has no resale or salvage or residual value, and it's going to be depreciated a straight line over 3 years for simplicity. Now, that depreciation is going to create a tax shield. In other words, by having depreciable expense, I'm going to reduce my taxes. And that tax shield is equal to the depreciation amount times the tax rate. Now, the operating lease will cost $1,500 per year, payable in advance for 4 years. In other words, I'll pay $1,500 today and then $1,500 at the end of this year and the following 2 more. Now, the lease expense is going to be a tax-deductible operational expense. So let's go ahead and calculate my values. So I'm going to spend $4,000 for the computer today, or I'll have a lease, which is going to be $1,500 today. And these are both pre-tax. Let's talk about a shortcut method to get the rest of the cash flows. Let's come down here. If we talk about operational free cash flows, or FCFF, I can say it's going to be revenue minus OPEX minus depreciation. That's going to be my EBIT after tax, and I can add back depreciation. So again, we're just talking about say future cash flows, and I'm just ignoring CapEx right now and working capital. So I'm calling these operational free cash flows. So if I can say that the operational free cash flows are revenue minus OPEX minus depreciation, my EBIT after tax, and add back depreciation. But I want to rewrite this. I want to pull out the depreciation from this summation here. So I can say it's my revenue minus OPEX, that's my EBITDA after tax, minus my depreciation expense times 1 minus the tax rate, plus depreciation. So again, all I did is I pulled out the depreciation from this part of the equation. Now you can see I can now distribute this depreciation into the 1 minus tax. So I can rewrite this section here as depreciation plus depreciation times tax. Notice when I do that, I have minus depreciation and plus depreciation, so I can cancel those out. So operational free cash flows, again the ones excluding working capital and CapEx, are going to be my EBITDA after tax plus depreciation times tax. Now what this means is depreciation is a non-cash expense. So normally we would include it as if it's a taxable, or as if it's a real expense, because it's going to save us taxes, and then add it back. However, you could do it a shortcut method. Ignore it and get EBITDA after tax, and just add the tax effect, which is simply the depreciation times the tax shield. Now I can go a little bit further. Another way of thinking about the operating free cash flows is just take my after-tax revenue minus my after-tax OPEX and add back my depreciation tax shield, again, which is just the reduction in taxes due to the fact that you have depreciation. So all operational expenditures also have a tax shield, just like an operating lease, but since depreciation is a non-cash expense, only the tax shield is included as the expense for depreciation. So this is just an alternative short way of writing this. So that allows us, in our example here, that if we want to figure out what's the tax impact of buying a $4,000 computer and you never have a future actual OPEX expense, an out-of-pocket expense. However, by the simple fact that you're going to have $4,000 divided by 3, that's going to be my annual depreciation. You're going to have this fake non-cash expense. I should just say non-cash expense of $1,300. That non-cash expense, if I multiply times the tax rate, is going to save me $533 in taxes in future years. So my real cash flows for purchasing this machine is I'll buy it for $4,000 today, then I'll save taxes of $533 a year for the next 3 years. Now if I do the NPV that is 2.6 or 2,649 as a negative, since it's a cost. Now, if I were to lease the machine, I'd spend $1,500 today, but again, every expense creates a tax shield. So if I take 1 minus that, the after-tax cost is only to be $900. Whoops, I'll just do a link here. I'll just anchor these. So then it's a choice of having the following two sets of cash flows. So you can see that the NPV of the purchase is less than the NPV of the lease, and since you need this computer to operate your business, you're going to just choose the purchase. One other note, notice I'm assuming that in this case I save taxes. So even though I have this expense here and this expense here, the fact that I'm taking the after-tax cost of an expense means that it's just shielding the company from taxes in other areas. In other words, I'm assuming this company is already profitable, and therefore any new operational expense here, which is a lease, is going to just save the company in taxes. So I'm going to spend the $1,500, but I'm going to write a check, or I'm going to send the IRS $600 less in taxes that year because the company is already profitable. It's going to shield their income. That allows me to take an after-tax OPEX, which is a negative number. So, in this topic, we evaluated a buy or lease decision, and we talked about the importance of tax shields.